Alrighty, guys, here we go. Now what we're going to be doing is looking at the uh, chapter 2, which is the approach of debits and credits. And what we're going to do is we're going to go over the transactions with chapter 1 that we did. But we're going to be looking at them now through the debits and credits and analyzing those business transactions, okay? So what we're going to do is we're going to be, again, looking at the expanded equation of assets equal liability plus owner's equity, withdrawal, revenue, and expenses. We're going to be looking at all of that again, and we're going to be looking at how we're going to classify that now as a debit or a credit, okay? This is what we call a T account, and the reason why is because it's in the form of a T. We have your date and your item and your credit. So you have a debit and a credit. And the rule of thumb is this. For every debit, there's a credit. Debit on the left side, credit on the right side, okay? So when we're balancing an account, let's say that this is our cash account. On the 2nd of April, we went ahead and took $5,000. We debited it, put it in. Then on the 3rd, we took money out. We're recording it. Then on the 20th, we put money in. Then on the 25th, we took money out. We total the debits, $5,600. We total the credits, $900. Then we subtract, okay, the credit from the debit for the cash account, and our balance provides us $4,700 that we have at the end of the month, okay? Simple, easy peasy. Each account or classification of account has its normal balance. So, for example, for your debit, it's an increase. Think about it as your cash, increasing your cash. When you credit, you decrease it, right? You don't have the money there anymore. Liabilities, the normal balance is a credit, and to decrease it, it's a debit, okay? And the rule of thumb is you debit and then you credit, okay? Owner's equity doesn't have anything. It stays the same. You never touch it unless you put more money in. If he invests or she invests, but typically you don't mess with it. Capital, again, the money is there for owner's equity. We go ahead and we have the money that the capital or the owner's equity of how much money they've got in there. So capital is credited. That's the increase, and it's debited when it's decreased, okay? Your withdrawals, you debit, credit, revenue, debit, credit. I know this kind of goes ahead and still seems like it's foreign, but you're going to be able to understand a little bit more when we do the transactions that we did in our previous chapter now, okay? So here, this is what we're looking at, the rules. Assets, liabilities equal owner's equity. So owner equity, debit and a credit for capital. Withdrawals, debit and a credit. Revenue, debit and a credit. And expenses, debit and a credit. Okay, again, what we're going to be doing here, okay? You see the little minuses and pluses. So with capital, when we increase it, we credit it. To decrease it, it's a debit. So on withdrawal, we debit it first and then we credit, so that if I were to go ahead and debit a withdrawal for $500, then I would credit cash, decreasing the amount there. When we look at the rules of the debits and the credits, because there's a debit and there's a credit, you'll see how everything works out, okay? You can have multiple debits with one credit, multiple credits with one debit, and you can have multiple debits and multiple credits. They all must equal out to the amount, okay? Everything has to be balanced regardless. This is considered what is called a chart of accounts. For Mia Wong, remember her? She was from chapter 1. She had her cash account, accounts receivable, office equipment, accounts payable. She had her capital, her withdrawals, revenue that she got, that she paid some expenses, rent, and advertising, okay? We're going to see what she did there. There's 5 steps to analyzing an account. First, which accounts are going to be impacted? Which 2 accounts am I using? Which one am I going to debit? And which one am I going to credit? Does it belong to an asset? Does it belong to a revenue? Does it belong to a withdrawal? The reason that you want to know is so that you can go back and remember what the normal balance of that account is. Then, is it going to increase or decrease based on the verbiage provided? What do the rules say about debit and credit? And then again, what does a T account look like? What is going to happen here? Okay? The increase or decrease, what's going to happen? So let's go back on what Mia did at the beginning. What she did was she went ahead and she decided to invest $6,200 of capital in her account. So, from her money. So she debited $6,000. She went ahead and she debited into cash, and then she debited $200 into office equipment, and then she credited her capital account. Okay? So she's got the money there. Notice again, increasing her cash, increasing her equipment, and then noticing an increase in capital as well. But it's a credit, yes, but remember the normal balance for the capital account is a credit as well. Okay? So here we go. Because of the fact that it involves more, even though we had $6,200, remember, it was debited twice and credited only once. See how you can have multiple debits and one credit. It works. Okay? Then what she did is she went ahead and she added more office equipment. And so we debit the office equipment and we credit cash because she bought it for cash. Remember the verbiage. And it balances out. 500 and 500. Debit and credit. Okay? Decreasing the asset of cash. Office equipment, she went ahead and she bought more, but this time she bought it on account. Now she has a liability. Now she owes something. So you still increase, so you still debit your office equipment, and you credit and increase also your accounts payable. You have the debit and you have the credit. It still balances out as to the accounts that are being utilized. Okay? Applying the transaction again. Here we go. For legal services. Oh, here we go. We now got money in. So we debited cash. Asset, it increases. And then it also increases the revenue, showing that we got money in. We're putting it into cash. But how do we get it? Based off the services that we provided on that day. Okay? The revenue. Recording the money that's coming in and going out. We provided legal fees again, but this time on account. Now somebody owes us. So therefore, we go ahead and we put it in accounts receivable, not in cash, because that money is not in cash. So we hold it in accounts receivable, and what we go ahead and we do is we still place it into, we credit it into revenue, showing that in the month of September, we now have made, excuse me, $5,000 worth of money. Even though we don't have it all yet, we're still recording it for all IRS and legal purposes. And this is just accounting. Okay? Then the other thing is we now receive $900 from what we have on account. So cash is debited because we got money in. So now it's credited. So now, debited. So now we credit the accounts receivable, right? Decreasing the amount of money that they owe us now. Now they only owe us $2,100 because they gave us some money. Okay? Keeping track of who owes us, who do we owe, and the money brought out and the money going out as well. Remember, she also paid salary. So here we go. We would go ahead and debit salaries, increasing it to show how much we're paying. Crediting cash, decreasing the amount of money that we have in cash. Okay? Then we also have the rent expense. So we debit rent, showing that there's an increase, showing how much rent we're paying. And then we decrease cash again through the credit. Then we have the advertising, same thing. Advertising expenses increased with the debit. And then our accounts payable, though, is the one that's going to be increased because, for somebody else, because of the fact that we're going to pay this next time. So now our liability could be to do different people because we owe $300 and $200, but now our liability total is $500. That's how much we owe. See how we're keeping track of all the money that is coming in, money that we owe, money that is owed to us, money that's going out. Okay? Then she withdrew money for herself. She's taking money. So here we show the withdrawal as a debit, and then money is taken out of cash. So money is now taken out as a credit. Okay? This is a summary of transaction. All the transactions in your assets, liability, capital, withdrawals, revenue, and expenses. And they all balance out. Okay? So now we're going to go into part 2 of this chapter 2. All right? See you on the flip side.